This is Chapter 3, Part 2. We have a second part because there is a lot of content in our Chapter 3. This will cover cash versus accrual accounting and the accounting cycle. There are two ways to keep accounting records, the accrual basis and the cash basis. Your textbook describes this in more detail on pages 112 to 116. On occasion, you will see a note at the top of the slide referring you to the textbook. The accrual basis of accounting records revenue when it is earned, not just when the cash is actually received. An example would be an electric utility company that provided electric services all month long but doesn't collect payment until the following month. With the accrual basis, the electric company should record the income for those services in the month they were provided. In the same way that a company should record revenue as they occur, they should also record expenses as they happen, and when the company becomes liable for them, and not when they actually eventually pay the bill. When the cash basis is used by a company, the company only records revenue or income when they receive the cash and only records the expense when they actually pay out cash. Adjusting entries are mentioned here because they help keep the financial picture in focus by recording accrued expenses and accrued revenues and also deferrals into the financial records. Let's have another look of an example of accrual basis versus cash basis accounting. Please pause your PowerPoint and read the paragraph. This is an illustration showing on the left side accrual basis journal entries and on the right side cash basis journal entries to record the revenue that NBC receives for providing advertising service on the day of the Super Bowl. You can see on the accrual basis side, February 3rd, the accountants recorded the income as earnings and didn't record the cash being received till the next month. On the cash basis side, there's no entry at all in February for when the services were provided. Take a moment to read the slide. NBC uses the accrual basis of accounting. Therefore, they will know what their revenue earnings were for February when they provided the service during the Super Bowl. If you looked at the financial statement on a cash basis, it would not include the $2.5 million that was earned from Pepsi. In Chapter 1, we learned the rules of accounting. They are called Generally Accepted Accounting Principles, or GAAP. The accrual basis of accounting adheres to these rules. The cash basis does not. The time period assumption is also one of the basic principle or rules of accounting under Generally Accepted Accounting Principles. It says that we can divide the life of a business into time periods or fiscal periods so that the owners can get immediate feedback on how the business is doing. On this slide, I've listed 6 steps in the accounting cycle. Please pause the PowerPoint to read each one. The third step in the accounting cycle is the preparation of the trial balance. Financial statements are prepared from the adjusted trial balance on the last day of the accounting cycle. We will spend more time looking at the different components of the financial statements in more detail in Chapter 4. Of course, accounting and bookkeeping involves a lot of paperwork that should be maintained in an organized way. Label your file folders and boxes and filing cabinets so that all of the numbers on your financial statements can be supported by source documents and that they can be easily located, so that you can avoid the situation in the next slide.